What if I told you there's an institution in America, not directly controlled by the president or Congress, that can affect the price of your morning coffee, the interest rate on your car loan, and even your chances of getting a promotion? It operates from a marble building in Washington, D.C., but its influence reaches every corner of the globe. This institution is, of course, the Federal Reserve. But what is it really? We hear about the Fed raising or lowering rates on the news, but the theory behind its immense power is often shrouded in mystery. How does it actually work? What is its core doctrine? And is its power truly justified? In this video, we are going to pull back the curtain. We're not talking politics, and we're not giving financial advice. We are diving deep into the theory of the Federal Reserve. We'll get the Federal Reserve explained from the ground up, its mission, its tools, and the powerful debates that surround it. By the end of this video, you'll understand the invisible hand that shapes our financial world. So, what is the Federal Reserve? At its core, the Fed is the central bank of the United States. Think of it as the bank for banks. While you and I use commercial banks like Chase or Bank of America, those banks have their own bank, the Fed. It was created in 1913 after a series of financial panics convinced Congress that the economy needed a central authority to ensure financial stability. But its role has evolved into something much larger. Today, the Fed's actions are guided by a core theory known as the dual mandate, given to it by Congress, to promote maximum employment and stable prices. This sounds simple, but in practice, it's a monumental balancing act. These two goals are often in direct conflict. Imagine the economy as a car. To get to maximum employment, you want to press the accelerator. The Fed does this by making money cheaper to borrow. This is called an accommodative or easing monetary policy. When interest rates are low, businesses are more likely to take out loans to build new factories, hire more workers, and expand production. Consumers are more likely to buy houses and cars. The economy speeds up and unemployment goes down. But what happens when you keep your foot on the gas for too long? The engine overheats. In economic terms, this overheating is called inflation. Too much money chasing too few goods causes prices to rise across the board. Your dollar just doesn't buy as much as it used to. To fight inflation and achieve stable prices, which the Fed defines as a 2% inflation rate over the long run, it has to hit the brakes. It does this by making money more expensive to borrow. This is a restrictive or tightening monetary policy. Higher interest rates discourage borrowing and spending. Businesses pause expansion plans, consumers save more and spend less, and the economy slows down, which helps bring prices back under control. The problem is, hitting the brakes too hard can cause the car to stall, or worse, go into reverse. A recession. People lose their jobs, and we move further away from the goal of maximum employment. This is the fundamental tension at the heart of the Federal Reserve's doctrine. Every decision they make is a theoretical trade-off between these two goals. It's a constant high-wire act, trying to keep the economy running hot enough to create jobs, but not so hot that it bursts into inflationary flames. It's a fascinating theoretical challenge. Which do you think is the bigger threat to the average American right now? Unemployment or inflation? It's a tough question with no easy answer. Drop your thoughts in the comments below. I'm genuinely curious to see what you think. So, how does the Fed actually press the gas or hit the brakes? It doesn't just call up banks and tell them what to do. It uses a set of powerful, though indirect, tools. The most important of these is the federal funds rate. This sounds technical, but the concept is straightforward. The federal funds rate is the interest rate that banks charge each other for overnight loans to meet their reserve requirements. You don't see this rate directly, but it's the foundation for almost every other interest rate in the economy. The Fed doesn't set this rate by decree. Instead, its main policymaking body, the Federal Open Market Committee, or FOMC, sets a target range for this rate. The FOMC is the group you hear about in the news. It consists of the 7 governors of the Federal Reserve Board and a rotating group of 5 regional Federal Reserve Bank presidents. When the FOMC announces it's raising rates, it's raising this target range. This single move creates a ripple effect across the entire financial system. Think of it like a cascade. The Fed raises the target for the federal funds rate. This makes it more expensive for banks to borrow from each other. To maintain their profit margins, banks then pass on this higher cost to their customers. The prime rate, the rate banks offer their best customers, goes up almost immediately. This, in turn, pushes up rates for variable rate credit cards, home equity lines of credit, and small business loans. Auto loans and mortgages follow as the cost of financing for lenders increases. Suddenly, that new car or house is more expensive. For consumers, higher rates mean less disposable income and a greater incentive to save rather than spend. For businesses, it means the cost of investing in new equipment or hiring new staff goes up. The overall effect is a slowdown in economic activity, which, in theory, cools inflation. The reverse is also true. When the Fed cuts rates, it lowers the target range. Borrowing becomes cheaper for banks, and they pass those savings on. Credit card rates, mortgage rates, and business loan rates fall. This encourages spending and investment, stimulating economic growth and, in theory, boosting employment. This is the core mechanism of monetary policy. It's not about directly controlling the economy, but about influencing the cost of money to guide the decisions of millions of individuals and businesses. And if you're finding this explanation of how the Fed works valuable, do me a favor and hit that like button. It tells the YouTube algorithm that this is good educational content and helps more people discover the channel. It's a small click for you, but it makes a huge difference for us. Thank you. Now, the Fed's power isn't just confined to the United States. Because the US dollar is the world's primary reserve currency, the Fed's decisions have massive global consequences. When the Fed raises interest rates, it makes holding US dollars more attractive to international investors. They can get a higher return on dollar-denominated assets like US Treasury bonds. To buy these assets, they need to buy US dollars, which increases the demand for the dollar and strengthens its value relative to other currencies. A stronger dollar makes US exports more expensive for other countries, which can hurt American manufacturers. But it also makes imports cheaper for Americans, which can help fight domestic inflation. For the rest of the world, especially emerging markets, a strong dollar can be painful. Many countries and international corporations borrow in US dollars. When the dollar strengthens, the real value of their debt goes up, making it harder to repay. This can lead to financial instability and even economic crises in other nations. Essentially, the Federal Reserve acts as the world's unofficial central bank. Its monetary policy decisions create ripples that can become tidal waves in the global financial system. When the Fed sneezes, the saying goes, the world catches a cold. This global impact adds another layer of complexity and responsibility to the Fed's theoretical framework. Given this immense power, it's no surprise that the Federal Reserve has been a subject of intense debate and criticism since its very creation. These aren't just political attacks. They are deep, theoretical arguments about the very nature of money and the role of a central bank. One of the most famous critiques comes from the Nobel Prize-winning economist Milton Friedman. Friedman and his fellow monetarists argued that the Fed, far from being a stabilizer, was often a source of economic instability. Their most powerful case study was the Great Depression. Friedman and Anna Schwartz argued that the Fed's restrictive monetary policy in the early 1930s, shrinking the money supply and letting banks fail, was a primary cause of the Depression's severity. They believed that the Fed's attempts to actively manage the economy often did more harm than good. Friedman's theoretical solution was radical: abolish the human-run Fed and replace it with a computer program that would increase the money supply by a steady, predictable amount each year, a concept known as the K% rule. The idea was to remove human error and unpredictability from monetary policy altogether. Another powerful theoretical critique comes from the Austrian School of Economics, represented by thinkers like Murray Rothbard and Ron Paul. They argue that the Fed's very existence is the problem. From their perspective, the Fed's ability to manipulate interest rates and create fiat money not backed by a physical commodity like gold, is the root cause of the boom and bust business cycle. They argue that when the Fed artificially lowers interest rates, it sends false signals to the economy, encouraging unsustainable investments and creating speculative bubbles like the housing bubble before the 2008 financial crisis. When these bubbles inevitably pop, a recession follows. Rothbard even called the Fed's money creation legalized counterfeiting that devalues the dollar over time. The theoretical solution proposed by this school is even more extreme than Friedman's: end the Fed entirely and return to a free market banking system, possibly backed by a gold standard. These are not fringe ideas. They are serious economic theories that challenge the very foundation of the Federal Reserve's doctrine. They raise fundamental questions. Should a small, unelected committee have so much power over the economy? Is it even possible to centrally plan something as complex as a modern economy without causing unintended consequences? This video presents these different theories neutrally to give you the full picture. The purpose isn't to convince you of one view, but to equip you with the knowledge to form your own informed opinion. So, why does all this theory matter to you? Because the Federal Reserve's doctrine isn't just an academic exercise. It has profound, real-world consequences. The interest rate on your credit card, the affordability of your first home, the value of your retirement savings, and the health of the job market are all directly or indirectly influenced by the theoretical framework we've discussed today. When the FOMC meets 8 times a year, the decisions they make, based on their interpretation of the dual mandate and the state of the economy, set in motion the forces that will shape your financial reality for months and years to come. Understanding the Federal Reserve explained in this way, as a powerful institution operating on a complex and contested set of theories, is the first step to understanding the deeper currents of the U.S. and global economy. It's about seeing the architecture behind the headlines. We've covered a lot of ground today: the Fed's theoretical mission of the dual mandate, its primary tool of the federal funds rate, its global impact, and the powerful intellectual critiques against it. The key takeaway is this: the Federal Reserve operates on a doctrine of balance, constantly navigating the trade-off between employment and inflation. Its power is immense, its task is incredibly complex, and its methods are the subject of ongoing, legitimate debate. If you made it this far, you're clearly serious about understanding how the world of finance really works. And of course, if you haven't already, make sure to subscribe and hit that notification bell. We release deep dives like this every week, and we'd love to have you as part of our community. Thanks for watching.